Hey everyone, today we wanted to take a little bit of time and talk about geopolitics and how they affect the market. It's no secret that really over the past several years, Matt, there's been major geopolitical events that people have wondered what influence that would have on the market. And obviously, the most recent being the events that are going on between Israel and Palestine.
Correct.
So what are your thoughts on this? How should people view this through the lens of their portfolio and the stock market?
Yeah, and so when it comes to geopolitics, the first thing that comes to mind is if an investor is waiting for the absence of geopolitics, they're never going to own any risk assets, right? So we got to know that going into it. You know, when these events come up, remember, from the financial world, we are setting aside all of the humanitarian impact of that and purely looking at it through the scope of generally the U.S. stock market and the U.S. bond market. The market tends to shoot first and ask questions later, meaning that they're going to sell, de-risk, and then determine, okay, they do the worst case scenarios first, and then as those come off the table, you tend to see the market recover. And so if we kind of take the past week as an example, you know, the market is trying to interpret, okay, how wide can the conflict get? How bad can it go? Let's price that in to the best of our ability. Then, as maybe the situation gets a little more certain and certain situations come off the table, you tend to see money coming back into the market. Now, obviously, this specific geopolitical situation that we're discussing, horrible, obviously. On the money side of it, as you get more certainty as the weeks go on, you won't see it as much in our financial news headlines. Is that a good way of articulating that?
Yeah, for sure. And, you know, I think an example of this, of, you know, the market shooting first and asking questions later, I think, you know, when the news broke about what was going on over there, energy prices shot up right away, right?
Yep.
Oil was up like 5 or 6%, I think.
Correct, sir.
So it's just the market trying to interpret, you know, what effect
Yep.
it is going to have, the ripple effect through the rest of the economy. So immediately when I think of rising energy prices, it's like, okay, if this thing lasts long enough,
There it
is this going to turn inflation back up? And is the Fed going to have to hold rates for longer than they anticipated?
That's right.
And if that's the case, then yeah, this could turn into more longer-term economic weakness for the global economy.
Yep.
So again, the market's trying to judge all those things and take all of these inputs and spit out a result for people. Obviously, you know, what's going on right now is horrible. We're praying for everybody involved. Count our lucky stars that we live where we do.
Yep.
But yeah, it's, you know, we'll have Jenna throw this chart up as it relates to the stock market. And I know several people have seen this before, but it outlines over the past like 50 years all of the geopolitical events that have happened.
Yes.
And the interesting thing is the market tends to take these events in stride.
They do when you take the big picture in play. Absolutely.
And that chart keeps going from the lower left to the upper right amid everything that has happened in the world over the last 50 or 100 years. And I think that's very telling about the stock market.
Well said. And I'll add one last thing to add what Mark just told you. Last but not least, don't let the headlines, whether they're geopolitical in nature or otherwise, let that derail your larger long-term game plan. Go back to what I said at the beginning. If we're waiting for the absence of risk, whether it's geopolitics or what have you, you're not going to invest in risk assets, and you're going to miss out on the long-term compounding effect, and I'll just speak for stocks, not bonds, of what stocks offer. And that's why there's no free lunch. You've got to sacrifice those periods of short-term volatility, i.e. the uncertainty of fill in the blank, to get those nice longer-term rates of return. Good way of saying it?
Well said.
All right. I'll do it. Join us next week for another episode of Questions with Mark and Matt. We look forward to seeing you then.